It's 6 o'clock in London. Summertime has happened. 2 p.m. in New York, 5 a.m. in Hong Kong, 5 a.m. in Sydney. Therefore, it must be 3 a.m. in Sydney, actually, and 5 a.m. in Hong Kong. That's a typo. 11 a.m. in San Francisco and 23:30 at night in Mumbai. Greetings, good morning, good afternoon, and good evening, wherever you are in the world. My name is Patrick L. Young, the IPO-VID Livestream, Series 4, Episode 6, number 24 in the canon of IPO-VIDs, starts here. To infinity and beyond went the prescient words of astronaut Buzz Lightyear in Toy Story, and doubtless that was his description of his blockchain and Bitcoin portfolio in recent weeks. Some say there's a bubble upon us in many things, while others say the inflation bug is creeping upon the whole world. The COVID economy is chaotic, but markets remain remarkably buoyant, while interest rates are at zero. Apart from the US Treasury bonds, where horrors. We have seen rates above a giddy 1.6% on 10-year notes and somewhere around 2.4% on the 30-year benchmark. Watch this space, ladies and gentlemen. Only a few hundred basis points more and that outbreak of the yield curve may yet be upon us. In other news, the European Union says Britain should give the Elgin marbles back, presumably to Turkey, who were controlling Greece when Lord Elgin bought gilded elements from the interior and exterior of the Parthenon. In fact, the EU seems eager to blame the UK for just about anything now that the UK has left the EU. After another spat of vaccine arguments over the course of the last week, where Brussels seems to have lost any comprehension of the simple first in, first out order rule, some gamblers are starting to put money on when the European Union will be blaming the UK for example, starting the Second World War. With Northern Ireland being held hostage, Brussels' annus horribilis carries on. And indeed, last week's IPO-VID guest, Daniel Hobson, made an excellent plea today for parallel markets. Are we going to see a euro? Daniel Hodson mused in City AM this morning, Tuesday, March the 16th. Elsewhere, good stuff from International Women's Day, albeit, again, how can we have a credible discussion about equality when over 50% of the population get just one day devoted to their annual contribution to humankind? Nonetheless, the headlines were fascinating. Firms with women in leadership repay loans better, noted a leading Jamaican finance firm, and that echoed from across the Caribbean throughout the world. It resonated in the heart of the Balkans, for example, where the CEO of the Zagreb Stock Exchange, Ivana Gazic, noted, if financial institutions' management boards are balanced, they act much more cautiously and rationally. In direct offerings this week, parents the world over can see their children building a bridge between their offspring's appetite for Robux and the transition to US dollars, as Roblox made their New York Stock Exchange debut through a direct offering. Here's to more profits in dollars and indeed Robux for all. Who knows, sooner or later will we see a central bank digital currency based upon Roblox's own little Roblox. Over in China, news that the owner of TikTok, ByteDance, have invested in a self-driving startup is leaving me with some concerns for the future of Chinese road safety. Digital asset founder Eric Saranyetsky was on this show a couple of weeks ago on the IPO-VID live stream, and he mentioned StockX. Now, StockX is a fascinating business relating to trainers and sneakers, as our American cousins would call them. That has an exchange, StockX, previously appeared amid the pixels of Exchange Invest. And it's fascinating to hear that during the course of the last week, the world of stagging sneakers, buying them in advance of a higher profit on issue, has now had its first high-profile veteran during the, well, interesting post-trade denouement. Nike veteran Ann Herbert was forced to quit her employer, Nike, of over 25 years after her son used her credit card to buy Nike shoes for a profitable resale. Digital markets and exchanges have viability in so many places, but they also create risks when it comes to real or perceived insider information and related conflicts of interest. Finally, the headline of the week for traders everywhere, ladies and gentlemen: derivatives get a bad rap, but they help keep hamburgers affordable. Take a bow, CFTC Commissioner Don Stump, for elegantly explaining the merits of derivatives with orderly markets and sound regulation in Washington, D.C.'s Roll Call magazine. All this and more, ladies and gentlemen, has already been covered in greater detail in Exchange Invest Daily, the unique newsletter of the Bourse business, and we're celebrating an incredible milestone. 2001 issues today, a whole new millennium, a whole new odyssey, an exchange odyssey no less, awaits us in the third millennium of Exchange Invest publishing. Send us an email or hit me up on social media wherever you're watching this video. Patrick L. Young is my name, and we can get you signed up to understand the exchange business. 30-day free trial now available for everybody who's interested. Today, ladies and gentlemen, we have a magnificent guest. Last week, we had a former CEO of the LIFFE Exchange. This week, we have a true LIFFE veteran. Neil Crammond is coming to us talking about bridging the trader gap across markets. Originally, Neil started his career on the Baltic Exchange in the City of London in grains and potatoes. Then he moved to the opening of the LIFFE floor in the Royal Exchange. And indeed, there's a great link between the Royal Exchange and the man who's going to be coming on next week, because Neil Crammond finds himself in between, sandwiched, if you like, two Gresham professors of commerce. And indeed, those Gresham professors owe their financing to the Royal Exchange itself, which was founded by Thomas Gresham many hundreds of years ago. Neil has acted as a broker and local trader in London and Chicago, as well as being a true electronic trading pioneer. Neil, good evening. Where in the world are you today?
Yes, Patrick, I'm currently just south of London in a place called Petswood in Kent.
Excellent. Petswood, what a lovely environment. That's a very nice place to be indeed. And somewhere that leaves you close to London, but at the same time elegantly in the leafy shires and the leafy suburbs of the capital of the UK. So tell us, what are you doing there? What's up?
Well, basically, someone asked me a few years ago whether I would like to bridge the gap from retail trading into professional trading. What I didn't realize was obviously the regulations and the fences that were put up to stop people attempting to bridge that gap. And obviously, I'm very glad that you welcomed me here today to try and explain and maybe ask questions. How do we bridge the gap between the retail trader and the professional trader, and basically what is the professional trader? Obviously, you could say, because I started in 1982 and obviously coming up to almost 40 years of trading, does that make me a professional trader? Well, actually it doesn't, which may obviously perturb you and many of your listeners who are thinking that anyway.
So that is a very good point. I mean, you think about it, here are lots of us. We've been on the floor of LIFFE at one point in time. You were there for a great deal longer than I was. You were there before me, and indeed you were there after me in my brief period on the floor. But nowadays, there is an outrageous amount of regulation, and it seems almost as if the regulation is to try and somehow or other stop people managing to trade and work their way up the investment ladder, or at least so it feels to me.
Well, I think that the sad thing is that obviously you probably remember being on the floor that we did have that transition as such from being one of those horrible yellow jackets, which you couldn't find the suit and tie to match, going through to becoming a blue button. The same happened with the stock exchange and obviously the commodity exchange as well. And therefore you were supervised and chaperoned so much into becoming the next branch, and then obviously giving your, I think the LIFFE was a silver badge that allowed you to trade supervised. But that whole link, or you could call it an apprenticeship, quite a popular word now in 2021, you were administered by both the London International Financial Futures Exchange and any other exchange. So there was that link and there was that help. Currently, as a retail trader, there is nothing at all out there for them to say, where can I go next? Where can I go from an amateur football player to a professional football player? And it's no surprise that when you look at most of the retail platforms out there, there's a little sign at the top there that says 80% of people who trade retail platforms fail. Now, that is probably one of the main reasons, or the carrot that said to me, I'm going to come in here and help the company out and get that 80% down to probably 40%. A big challenge, but in a way, all of this is opening doors and giving people opportunities into what they could trade.
It's fascinating, isn't it? I mean, years ago, I was involved with one of those sorts of platforms very briefly for the simple reason that I did the calculations before the regulators asked, and it was obvious everybody was losing, as you say, 80% of their money within 2 years. And I said, why don't we actually spend some money and try and keep these people trading and educate them more in order to stay there? And the management just looked at me askance. We don't want to do that. You just get new customers in and then you get rid of their money. And then and it was really like that fantastic definition by Woody Allen of a stockbroker, somebody who invests your money until it's all gone. And I think it's a terrible, I mean, unfortunately, there's a very cynical element of the brokerage community out there that I really find it very difficult to approve of.
Well, I think, and we don't want to name and shame people or companies. We're not on here to do that, really. But like you've made very clear, 80% of people do fail, and a few of the companies are quite happy because they've got a revolving door. And especially since the lockdown, the in fashion thing, as we can't wear any fashionable clothes, is to become a so-called day trader, whether you're retail trading for obviously Robinhood or anyone else. But I think currently, ringing up, we obviously have new clients coming in every week and educate to trade. We have to monitor them and see if they're fit for purpose to carry on. However, the waiting list for them to join some of these retail platforms now are probably 2, 3, 4 weeks.
Yeah, it's fascinating. I mean, there's been such a growth in the number of traders, and obviously I think one of the good things though is at least now with Robinhood, and we can discuss payment for order flow and all those things separately, at least the good thing is that these people are actually trading on regulated orderly markets, because they've been so long where people were trading in rather, some might say, shabby OTC markets that didn't necessarily give them a fair go in the first place.
The one thing, I'm smiling, I shouldn't really smile, you didn't mention the word orderly, and Robinhood and orderly I think we're slightly wide of the mark, and then this is the issue from retail traders who are trading, and I'm sure you were very much aware of it, and we'll sort of pin it down in that if we traded on the market even 5 years ago, and for instance, GameStop, was it last week, moved something like 40% in 10 minutes flat. Well, this is where the regulation or more Daniel Hodgson and other chairmen of the exchanges, I mean, Mr. Berkshire, when it first opened in 82, they would have closed that contract down until it sorted it out, because one of the first rules of as an RIE, a recognised investment exchange, is to provide that indeed fair and orderly markets. And sadly, maybe due to volatility on some of these markets, and we can include cryptos as well, markets that swing 10-20% in an hour and a half basically are not fair and orderly markets. And for anyone new coming in, should steer well clear.
Yes, I mean, it's incredible some of the volatility we've seen, particularly given the fact that we've just gone through a really low volatility decade in many senses.
Yeah, and then obviously quantitative easing, stimulus and everything else made that. And obviously when you think that VIX index came out in 1993 and the lowest it's ever been, it's like 10 or something, just above 10, and up to 2017 we were just below 10, I think even up to last year. And obviously you can't predict a pandemic as such, but I think this time last year the VIX index shot up to, I think, over 80, and obviously we're now back to the low 20s, but that's still a high volatility that we've seen in the last decade.
Yeah, it's really interesting. So we've got this very high volatility market. We've got lots of new retail investors who are trying to get in, and they're hitting this brick wall because it's very difficult to get yourself up to professional trading standards. So tell us, I mean, without giving us all the secret sauce, how do you go about trying to elevate people into being professional traders?
I think the main thing is from those professional traders, or the retail traders, they come in with the wish to thinking, I want to drive that Lamborghini and everything, and that the helicopter and the plane, which you see on the adverts. And obviously we know through foreign exchange as such, the regulation is less than obviously other derivative companies as such. So basically it's giving them the education to learn how to trade. I mean, we have people who come in, for instance, and I'm sure you know that tomorrow is a big day for the FOMC, and Mr. Powell's got to make a great speech this time tomorrow. Was it 6 o'clock to 6:30, and where he can put interest rates or whatever he can do. However, most retail traders would not have a clue. And it's the same thing when we first asked you when they come in, and then retail traders may have dabbled a bit. Remember that most of them are hobby traders. Remember, most retail traders who come in, it's not their career choice. They have another job. Now we have, I know, the butcher, the baker, candlestick maker. We have professions everywhere who also want to trade because they enjoy trading. Most of them don't actually come in for the extra money. After a while, they enjoy the thrill of trading and making the money and the challenge of like playing a game of chess, I suppose. So again, one of the first questions we come in is we always ask them is that if there was a bomb in the Houses of Parliament now, what would you trade and why?
And I'm sure you get an incredibly exciting range of answers.
We have answers from ringing your mother to obviously selling the stock market and most other things. But in all fairness, most retail traders are fairly switched on as such, and they normally would say they'll just buy gold, which is obviously probably the most correct answer there. So it's just that when they sign up to a retail platform, of which there are many, God knows how many retail platforms are out there, hundreds probably, they don't give that advice. In fairness to them, they have massively improved on that service, and without doubt, I'm sure the regulators have told them to, because I think, or tell me if I'm wrong, January the 6th this year, a lot of retail traders were not allowed to trade cryptos, obviously because of the volatility, until they were established as a professional trader, which is a positive.
Which is the positive, and certainly, I mean, that sort of licensing is no bad thing. But of course, one of the difficulties, and this goes back to your original point, is it's incredibly difficult because the licensing seems to be such a miasma. I mean, it's almost, if you haven't traded the product, then you can't be regarded as skilled enough to trade it, but you can't trade it because you're not allowed to trade it. And that seems to be a huge degree of the problem with regulation these days.
I think it is, but I mean, obviously, when you invited me on here, and thank you again, I asked quite a few people around it, and I think it comes down to the same when you're on the live floor, and obviously you would deem to be a local on the live floor, but in theory, you were just a self-funded trader who cleared as an NCM through a full clearinghouse as such, and as a self-funded trader, you had no interest in trading for someone else, either you've been a broker, you were just there to rob, cheat, and steal, whatever you want to say about it, nip and tuck, make your money, provide a bit of liquidity for the exchange, and that was your living, full stop. The problem now with the retail trader and everything else, the self-funded own account trader cannot, in theory, become a professional trader.
Yeah, that's rather weird. So is there a way to manage to break through from being the self-funded amateur trader to being regarded as being a professional?
Currently, obviously, you have to go through your compliance, and obviously, if you are a self-regulated trader, so self-funded trader, you don't need to be regulated either. In all fairness, because as long as you put your own account up and you know how to trade, why would you want to become a professional trader as well? So it works both ways, because in theory, if you're under that 75 grand, you're probably protected if anything goes pitong as such. But however, if you're a professional trader, you don't get that protection as such. So in theory, would we advise retail traders to try and become a professional trader, or hide behind them being so-called an amateur trader with a large account?
So let's say, stepping forward from that, obviously the thing we're really interested in this evening is looking at the skills gap. So, I mean, how do you go about it? You've told us you tell some stories and you bring people in and you sit them down, but when you're dealing with the butcher, the baker, the candlestick maker, or whoever it is, how do you go about structuring to help people improve their trading longevity?
The trade longevity, what we try to do on a simple one-to-one course, we basically fill the diary in obviously to 12 months, and we split that into a month. And we know that every figure that comes out in the UK, in the US, and Europe comes out every month. So we know the first Friday of every month is non-farm payroll and ISM. We know every 5-6 weeks with a central bank, and obviously this week we've got the FOMC, the Bank of England, the Bank of Japan. So we spend a whole month with them going through every single figure. every single day, every single opening, every single Wall Street. So basically, although it sounds as though they're here for 25 days, in theory, we're looking at an 8 a.m. opening, obviously for Europe and the UK. Obviously, this week, it's a 1:30 opening because Wall Street's put their clocks forward as such. And obviously, we go for the close as well at 4:30 for the UK. And obviously, the US closed this week. For the next 2 weeks is 8 p.m. So we try and replicate real-time trading for the whole month. And in theory, once they've done that, in theory, you're saying, well, you just repeat that for the next 12 months or 11 months, to be honest. Yeah. So we try and get as close as we can to making them as a professional trader, real-time trader, and see if they like it. Obviously, after a while, most of them are saying, well, actually, I can only really trade from 5:30 to 9, which is okay, because remember, so many locals working in London and Chicago only work 3-4 hours a day anyway.
Yeah. No, it's true. And I mean, it's an interesting point, because also now in this era of what I would call super liquidity, it's so easy to manage to pick even 2 or 3 hours in the USA with the S&P and the NASDAQ index futures, just to name a couple of stock indexes. And I mean, the possibilities in options are simply beyond belief if you want to trade these days compared to what we were used to, say, 30 years ago.
And I think, and in all fairness, to some of the big exchanges, I mean, the CME gave a fantastic lecture last week, which lots of our members went to, about explaining S&Ps, mini S&Ps, and obviously the options as well. So that helps as well. And I think the exchanges are trying to bridge the gap. But let's say that, as you know, what happened probably 5 or 6 years ago, if you wanted to trade on the exchange, the full clearing members upped whether you had an account from 25 grand to probably 50 grand or even more. So therefore, that priced out quite a few locals who were on the floor who maybe only wanted to trade small clips. But obviously, they probably traded those clips 30, 40, 50 times a day. So they were thinking, actually, the exchange don't want us anymore. But obviously, you know full well that the full clearing members, who were probably 400 or 500 in depth, say 10 years ago, and probably now down to about 50, 60, who want to take on independent traders. Yeah. So those traders thought, well, actually, I can't afford to have that in my account and not use it, and I don't want to put 50 grand or 75 grand. I might as well go back, or not back, I might as well try the retail trading out. So there's no surprise that some of these retail platforms have grown tenfold. And in theory, what Robinhood have done, very simple, was to encourage that 18 to 24-year-old who couldn't ever get into the exchange or will never be allowed to, and get them up and running to making money as such.
Yes, it's absolutely fascinating. And in fact, ladies and gentlemen, I'm here with Neil Crammond this evening. My name is Patrick L. Young. Thank you for joining us on the IPO-VID live stream. Don't forget, Exchange Invest is the daily benchmark newsletter about exchanges and market structure. We're celebrating our 2000th anniversary issue. That was yesterday. 2001 was today. We're now into a whole new exchange odyssey as our third millennium is upon us. We're read by the leading figures in the parish of exchanges across the world. I'd like you to be part of that community. Send us an email, join us on social media, send us anything that you would like in terms of a message to let us know how we can get in touch with you, and we'll give you a free 30-day trial too. The newsletter, the unique Business of Bourse's daily insight. Now, meanwhile, also, ladies and gentlemen, I'd love you to give us a bit of love this evening. So if you could manage a little like across the bottom of whichever social media you're watching this live stream on, it would be really, really welcome. And indeed, moreover, why don't we ask a question? We've got Neil Crammond in the studio today. He's talking to us from Kent, just south of London. And he's discussing, well, the whole business of trading. We've got someone in front of us who's got a 40-year history of trading markets, trading derivatives and all sorts of products, from potatoes to financial interest rates and equity derivatives, amongst others. Send us a message, send us any sort of a question you'd like. We'd love to hear from you, ladies and gentlemen. Neil, just thinking about what you've been saying, I mean, it's very interesting, this whole Robinhood phenomenon. I mean, one thing I find fascinating is the fact so many people are very, very eager to give their money to a company called Robinhood. I mean, at least the Sheriff of Nottingham actually had a large castle where I'd have thought once segregated funds were quite safe when they were stored there. And I hear today that actually there's been a huge funding round for a new Robinhood competitor, I kid you not, called the Great Gatsby, which definitely suggests that branding has moved into a whole new paradigm that I'm not sure about. Looking, though, at the Robinhood phenomenon, Do you think that has been a positive thing for markets, a negative thing for markets, or is it just too early to tell?
It's a very good question. And obviously, going back to when we were open outcry, and obviously Daniel Hodgson, your last guest, was the last chairman of the exchange when we were open outcry, and we had to expand. So at the time when we were trading open outcry, we were basically, even though we had a computer system called the APT, it was only available, within the M25. So obviously we had to expand, and therefore we had all these new exchanges open up everywhere, and that's what the market wanted, and that's what they got. However, you get the rough with the smooth, and the problem with Robinhood is the same with all 18 to 24-year-olds, and we have many coming in, as I just said. They call the you only live once, the go-lows, everything else. They don't come in as someone who would say in their 30s or 40s who wants to invest and make money. They've come in and say, I've got $5 to lose. Yeah, so it's a whole different conception of how they want to trade. They're obviously they're not as gung-ho, but they're 10 times more gung-ho than we ever were when we were 18 to 24. Are those 18 to 4-year-olds richer, or do they have, say, 2, 3, 4 grand? I don't want to say to waste or to lose, but I think they talked and said, I've got $3 to have a go. Hence these from Robinhood, they've used that go low very well, and I think their last count they had over 18 million clients.
Yeah, it's an incredible number altogether. But then let me ask you a quick question with that. Say you've got £3,000, £4,000, £5,000 or dollars these days. Is that really viable from which you can manage to start building yourself a trading, if not a full-time career today, at least start building your pot towards a trading career? Most
of our retail traders who come onto our Educate the Trade books, and one of the things we do offer, which has been very popular, is the risk management tool, where we basically teach them, and as it's quite weird, and obviously it doesn't probably happen in most of Robinhood shares, but we instruct them, mentor them that they shouldn't lose more than 3% of their account a day. So therefore, when they see the go lows, thinking, oh, I know, I bought Bitcoin at 40,000 and sold it at 50,000. I've doubled my account. In reality, we know that could work the other way. So as much as we love to double our account, we'd hate to blow our account up. And sadly, a lot of those go lows we've seen in the last 2-3 weeks, we may have seen 1 or 2 have said they've done fantastically well, but the majority of them, I'm pretty sure, have blown their accounts up. So in theory, yeah, most of our traders who come in on the retail, we advise them to start with $5,000. No more than $5,000, because in theory, as you know, you have to accept that you are going to lose money now and again, but how much money you lose in your discipline is probably the only way to go forward. And I think some wise man said many moons ago, you count the pennies and the pounds will follow.
Yes, absolutely. And certainly it's very interesting, because I think, of course, one of the other problems can be that when you do turn up with £5,000 or dollars, you can't actually get an account with anybody except some of the really shonky operators, which can be a challenge.
I think, in all fairness, I mean, when some of the main ones, IG, CMC, ETX, who we use all of them. We don't particularly point any one of them, and compliance-wise, we know that, so we can't. And most of them have been very good. And obviously, the problem they've got is that they haven't got the manpower to teach those traders to say, this is your discipline, this is your anything else. So in a way, that's where we've come in a way to take them on board ourselves as such, and help them not to blow their accounts. In the same thing, if you've got a £5,000 account, making £50 in one day is quite an achievement. Yeah. And the same thing, you know, years ago when you were local on the live floor, you did exactly the same thing. However, you were backed by a big company who probably gave you a cut of 50-50 or 40-60, and therefore it went that way. And the issue you've got at the moment, there's not that many prop houses out there who are willing to take you on, because the cost of training someone up, as I've spoken to you before, is costly. It's probably about 30-40 grand, but also it probably takes about 12 to 15 months to train people up. Yeah. Well, actually, we had Lee Hodgkinson, who was on just a month ago, from not far away from you in Kent. Very close, yeah. Exactly. 5 miles down the road.
Yeah, precisely. I mean, the clustering effect in Kent of the world's prop trading houses. And it was interesting to hear from him because he was talking about OSTC and how they've got a very technologically driven methodology and approach to training people, which I think is fascinating because they've really, it's amazing to see a group of guys, 3-4 guys who came from the floor of life, and they ended up with this amazingly complex methodology by which they're training people, they're monitoring their fitness. I mean, it's truly sci-fi stuff.
I think you'd be fairly shocked that when the floor shut, I went to work at OSTC in Bromley as a futures trader, and obviously remember, you might remember them, David Kite Futures. They when they first started, they were part. I think it was on-screen trading, and they merged with trading technology, so that they became OSTC, and their business model is superb. And Danny Langley, Rob Brophy, and Johnny Ocamps and Mark Slade done a fantastic job. And anyone else I missed out there, and Lee Hodgson has come in the last 2 years, and a superb CEO.
Absolutely, superb CEO altogether. It was great to have him on the show just about a month ago. You can catch that. Go to youtube.com, look for IPO-VID, and you can get all of our back issues, including the interview with Daniel Hodson, former CEO of LIFFE, to which we've been referring earlier this evening. And of course, you will be able in posterity to catch this excellent interview with Neil Crammond. Neil, we've got a couple of questions. Oh, very interesting one. We've got LinkedIn. Somebody's asking us, where should I start trading? Where should I start trading? Stocks, bonds, options, futures, Forex?
I think it's a very good question, and obviously most of the people who come into us, and we've got the sales team who answer those questions. Most retail traders who come in think they can only trade Forex, and I think that is part of the education that we give out to them. Is that as you well know, you can trade all of those things and many more things. I think you've missed out commodities. And obviously, he's missed out cryptos in the way you could trade cryptos. But two of the hardest things to trade are the two wings you've got there, the stocks and the Forex. I've always said to people, when we're teaching people and you're learning, there are some there are other contracts that you can trade when you're learning that are less risky and easier as such to understand. And obviously, when we go through on our one-to-ones, we go through all those contracts. Stocks, bonds, options, futures, and Forex. And anyone will tell you, options are a nightmare to understand. Just when people say, why are they called calls and why are they called puts? C'est la vie, you get over it. And obviously, the more you get into trading, the more you understand what to trade. And the same thing with Cheltenham on this week, horses for courses. Obviously, with Powell and the FOMC tomorrow, you probably would trade bonds and Forex over other things.
Yes, absolutely fascinating indeed, with Cheltenham on this week, and of course St. Mea's Day tomorrow. A very happy St. Patrick's Day to everybody in advance of the great Irish National Day. Please, in the spirit of political correctness, remember this is the one holiday where we fully anticipate that you will be culturally appropriating everything Irish, no matter whether you've got any Irish gene or none whatsoever. It's a big day, and just go out and celebrate. And if you can't go out, stay in and celebrate. Thank you very much, Marianne Madeira. We've got a like on Facebook. Really appreciate it. Hope you're having a wonderful night over there in, I do believe, the Philippines. It's lovely to hear from you. Hugely appreciate it. Thank you for all the support, ladies and gentlemen. Gets us rocketing up the search engines and allows us to get and enable guests like Neil Crammond to be heard by more people, and therefore more people to understand the science of investing. We're going to get to a great question about the science of investing in a moment. We've got a series of questions are rolling up. A third already in the mix. If you want to ask one, ladies and gentlemen, this is your opportunity. Talking trading education with Neil Crammond. So, Agata Bellon. Agata, good evening. It's lovely to see you. Okay, Agata is asking, there's a good one. What's the best book I can read about trading like a professional? Have we got enough time, Neil?
Well, there's obviously a multitude of questions that you can read. I forgot the title, and I'm sure hopefully someone will come in. I think what we look at, it's the Economic Atlas of Economic Indicators. I think it was written by Mark Standish or something else. I think it was last printed in 1992. And I call it my Bible. You can't buy it new. it did cost about £4 or £5, but I think it's because so many of our students last year have taken it up. It's about £40 or £50 now. It basically tells you what every figure is in the US. And obviously, and some European figures, and some of these figures, names have changed. I'm sure Patrick remember the word napalm, which is now changed to some other things. Obviously, we can't call things napalm anymore for many reasons. But all those names, they tell you why they trade those things. And I think one of the biggest things I tell the retail traders, and they come across, they all think the markets move on technical reasons. But anyone who tells you who's trading a proprietary house or a hedge fund or anything else, it's normally news or fundamentals that move markets. So those books try and get things as real as possible. And obviously, it will tell you what the GDP is, what the equation is. If a higher GDP, what do you want to trade on the figures? If it's good for the dollar, if it's good for the bond, if it's good for the equities, all those things, they really help you. So that therefore, when you go to most people's desks, they have it on the desk. And I've just seen George Brown there has said the Atlas of Economic Indicators. Thank you very much. I normally have it on my desk, but I lent it to a student a couple of weeks ago, and he's still reading it, obviously, because it's the FOMC tomorrow.
Very good. Thank you very much indeed for that intervention, George Brown. I'm going to come to your question in just a moment. It's the Atlas of Economic Indicators, a visual guide to market forces and the Federal Reserve. And it's by the fabulously titled W. Stansbury Carnes and Stephen D. Silder, I think, or Slider. It's quite difficult to read. Reading it off my small prompt screen.
And I think it's Harpers and Collins. I do think, I may be wrong, but I do think they are both deceased now.
Right.
Because I think they both wrote it in 1970.
Yes.
But that's the one I read, and every now and again, whenever the figure comes out, I reread it. It's a bit like, as I said before, it's a bit like your Bible, so you understand a higher figure, what it affects, what markets, and etc. So a very simple. If you're a professional, read it. It doesn't take very long.
Excellent. That's brilliant. And thank you very much for the pointer. Thank you for the question, Agatha Bellon. And thank you also for the pointer, George Brown. I'm going to come to your question in just a second as we move on from the Atlas of Economic Indicators. And we are moving to a regular on this show, as indeed, thank you very much to the producers on flying form this evening. There we have the Atlas of Economic Indicators, a visual guide to market forces and the Federal Reserve by W. Stansbury Carnes. It's a mass market paperback, apparently, published last printed in, I believe, 1992. Let's move to John Folk. Good evening, John. It's lovely to have you with us again this evening. Thank you very much for both watching regularly and your regular questions. What a good one this is. Ooh. So, what does a human trader bring to the market compared to an automated or AI trader?
Well, in a way, I think I used John's words. Are they the same thing? In theory now, most of the platforms you can use now with many mice, you can be a human trader or in theory, a human algo. The argument being is that how fast can you be? Is an AL trader faster than a human trader? The whole thing of why people moved over to automation and why high frequency traders did up to last year have 85% of the market, and obviously that's dipped a lot in the last year. Maybe basically because to me the co-location, that their screens or the servers can't be as near to the exchanges because most of them are working from home. So all of a sudden the speed of the AL trader has slowed down, which has allowed the human trader, or as we know them in the old days, the point and click trader, to catch up. The same thing when the motorways are at 70 miles an hour, the fast cars overtake you, but when they put speed restrictions up and you only can do 50 miles an hour, it doesn't matter what car you're in, you're driving at the same speed. So from a human trader point of view, his emotion may come in. I think a lot of automated traders tend to buy highs, a lot higher than human traders do, and sell lows as such. And it'd be interesting to see when you get a big event. And let's get it right. This time last year, when Wall Street was, I think it's maybe tomorrow, Thursday, this time last year, the 17th, I think what it was, the Wall Street moved 3,000 ticks in a day. I'm pretty sure that most of those automated AL traders didn't have a great day, and without doubt, the majority of human traders who are trading had a field day. It's probably the best day of the year.
Yes, very interesting. Therefore, on the truly big day, you're probably looking at the human trader as opposed to the AI trader.
I think normally in most things, if you're a high frequency trader, nitpicking, taking ticks here, ticks there, when a volatility day comes, very often we do see the liquidity shrink, because most of those AL trades, automatic trades, will just turn their machines off. And I'm pretty sure the Citadels, the Virtue, the D&Ws, you name them, would struggle with the markets very, very fast.
Very interesting. And actually, John Falk's coming up with a follow-up, which I'm going to take first, and then I'm going to get to your question, George Brown. Apologies for that, but it's not first in, first out, the algorithm for questions here, because I think this is a follow-up. Oh, good. So he's saying, does the human trader have a better feel for how a market may move? And he's saying Neil has already answered the second question. Thank you very much. Hey, thank you, John, for asking the question. It's a pleasure to see you this evening. So
I think also quickly go to what John said, is once you understand the price action, especially as a human trader, and you can find that market profile or whatever, I mean, you can see a tide go out and a tide come in. It doesn't take very long to take that skill on. And when you've got big orders coming in, like we have certain times out of the day, like on Wall Street, most openings, you tend as a trader to go with that trade.
Very interesting. Thank you. Thank you very much, Neil. Thank you once again, John Falk. Ladies and gentlemen, if you want to ask a question about trading, now you've got the opportunity to talk to a genuine polyglot of the trading industry. He's been around it for 40 years and can talk just about any market you want. He's traded in London, traded in Chicago, and all over the world, from the comfort these days of Kent in the Shires just outside of London. So, George Brown, thank you very much. You came up with that name, the Atlas of Economic Indicators, a moment ago. Really appreciate that. And you've had this question. Thank you for waiting patiently. As a new trader, how many hours per week should be looking to research on the side of a full-time job? And do you offer flexible one-to-one teaching?
Oh, I think I'm right, and you tell me if I'm wrong, Patrick. I think Warren Buffett said you have to read 500 pages of news a day to be a research trader. I tend to think I'm not too bad. I probably read about 15, which is enough for me. And obviously, the second question to there: do we offer flexible one-to-one teaching? I think what we've done, I think I mentioned it earlier, is that what we're trying to do is to replicate real-time trading. So you put yourself as a professional trader, and you probably have 2 or 3 junior traders or retail traders who are thinking about taking a job on full-time. And obviously that may be their aim. So we put them through a sort of months of training, each figure as we go on Monday, Tuesday, Wednesday, Thursday, Friday, times 20, the days in the month. And hopefully then they will see what a professional trader or a full-time trader has to go through every day. And as we said before, sometimes when it's quiet, you may only come in for 2-3 hours a day. However, most professional traders will tell you they're probably at the desk for 8, 9, 10 hours a day.
Yeah, it's a lot of work. So therefore, if you're trying to get your feet under the table and you're trying to trade part-time, which obviously George is talking about, while he's learning, what sort of time should he balance actually between reading and learning and actually trading?
I think once you understand the fundamentals, you do the technicals, and you can split it into 3 or 4. You've got the technicals, you've got the chart that you need to learn, and that takes its toll. And there's certain courses that we provide educators that follow that. We obviously, as we mentioned, do the one-to-ones. That only takes a bit longer, over a month. But I think it's the same thing. Is the question we get asked a lot is how long does it take for one to qualify as a competent trader? Yet again, I didn't use the word professional trader because I think that's the wrong word to use. How long basically till I can earn money to pay my bills is something that I've probably been asked probably thousands of times over the last, not 40 years, it's definitely the last 20 years since we've been on screen. And I think I mentioned that to you before, it's probably 12 to 15 months. And then therefore the more important side of it is therefore, can you fund yourself for that time while you're learning to trade. Not as I said before, having that 5-10 grand in your account that you need to trade, because I think, like you said earlier, having a too small account, you're not going to learn anything, and you're probably going to blow your account. However, it's the same thing like anything else. If you go to university or anything else, you know, you don't get your degree till 3 years. In a way, we could train you up, but I think in theory, although this year and last year has been easier because obviously we've had a mega year 2020 and 21 due to the volatility and the pandemic and such, I would say you probably have to look at it minimum of 1 year.
So it's going to take you a minimum of 1 year. And actually, John Falk has asked a great question, which is a follow-up related to this question. Thank you very much, George Brown, for your question this evening, your interventions. Feel free to ask another if you'd like to. But John's asking an excellent point, which is this a young man's game? Do you have to be under 30, male or female, to be a successful trader these days?
I think, obviously, what's happened now, we said before, these YOLO traders, as we said, and I think majority of the Robinhood traders were 18 to 24. And obviously Robinhood went looking into those universities in America for those very people. However, as you said, to be a successful trader, do you have to be under 30? I think it's the time you put in now, in that, because you can be sat at your desk, you can be anywhere. You can even be in Malta and trade, someone tells me. Yeah. I think it's the time you put in. And a lot of people we take on as students are 18 to 24, but a lot more recently, due to maybe redundancies or whatever, I would say are in their mid-30s to above.
That's very interesting to hear. There's the possibility, who knows, Neil, we might even be able to make a career for ourselves at our age. Might even happen.
Well, I think it's quite funny. When I worked, obviously with the live floor as well, there was a chap called David Morgan who was definitely not 30, he was probably 60 or 70. And obviously in Chicago, in the commodity pits, the Chicago Board of Trade, some of the people there who trade on the wheat floor were definitely in their 70s and turned up every day to trade. And you know what? They had total respect.
Yes, I agree completely. And actually, David Morgan, I don't know whatever happened to him, but he was an absolute landmark of the live floor, which is incredible because he was only about 5'6", if he was even that. But yet he was a landmark on the floor. I
think he's still going. He still turns up to the ex-life life dues, and if you remember rightly, Nigel Farage is the next lifer as well.
Yes, absolutely.
Not to name drop or anything, but one of the greatest things for David Morgan was, although he wasn't a great trader, he was a superb mentor to hundreds of traders.
Yes, he was a fantastic manager, mentor, and actually he really found an incredible niche because hundreds of people got a living as a result of the way that he managed to manage and organize things. And he was an amazing asset to that business. I'm delighted to hear that he's still going well. I haven't seen or heard from him in good grief probably 20 years, but that's absolutely super because it just shows you live longer if you've got the excitement of trading in your veins. That's obviously the message we have to come away with today.
Exactly, yeah.
So we got a couple of more questions that have come along. Thank you very much, John Falk, for your questions today. They've been really, really fascinating. Susan McFarlane, good evening, Susan McFarlane. It's absolutely lovely to hear from you today. And you've got a great question. Is this trading something I could do as well as being a full-time mum?
Oh, very topical at the moment. I think it's the same thing. That once we go through and we go through, as I said before, a lot of the one-to-one courses that we do, and obviously I said before to Patrick that we have the butcher, the baker, the candlestick maker, and currently I'm on the one-to-ones. I've got 2 electricians on my books who are actually learning to trade, and what we're working with them is that they're going to trade, as we said before, 5:30 to 9 o'clock. Obviously, it'll be 8 o'clock this week because of the American time lapse as such. So therefore we fit their trading into what they can fit, because they're obviously got a 9 to 5 job or 8 to 4, whatever it is. So in theory, we have quite a few women on our books who are very good traders, and the same thing is that they do the school run, they come back and do the tea run, and like you said, you can virtually trade I think probably 15-16 hours a day, and those who are even more loopy-loo, you could trade the cryptocurrencies 24/7 as such. And I'm sure Patrick remembers very much, we worked on the live floor. Some of the scariest people on the floor were female traders. And total respect to Val Chitty. Remember Val Chitty? Who went on to work for, I think, ICAP and anything else. You would not mess about with many lady traders on the floor.
I think there's a very rich seam of women who've traded around the world, and they've been all sizes, shapes, forms, you name it. Chicago had many great lady traders throughout its history. I think the question is a great one, Susan. I personally will tell you, definitely go for it. It's an absolute possibility for you. The clear thing is to find the markets and the times that work around your day, because you can do a school run, you can come back. You might find that your métier is perhaps trading options, because you can structure those during the course of the day and they're not quite as volatile as other things, so therefore you can leave them during the school run. It's a great opportunity, and in fact we've got an excellent question from a LinkedIn user which seems to be following up on that, so I'm going to take the last question in the stack before returning to a digital asset question. Full-time mums are like part-time dads. Everybody is welcome, right?
Well, the main reason, let's get it right, let's nip it to the bud really. The main reason you come into the retail trading or professional trading or trading anything is hopefully to make money as such. So if you've got the willingness to learn, you can succeed. So part-time is everything. I mean, sometimes like here today, I've probably done a 12-hour day, but other days if I want to and have to leave early for your kids' sports day or to pick your kids up from school, or even, as most people do, I said before, have another job. You can fit this in with trading. And the same thing is that once you get over the aspect that you may have missed a busy day on Monday, but you know it's a bit like a London bus, another one's going to come along very soon. So the period of a month, we're probably going to have at the moment 8, 9 or 10 busy days. And because you have the calendar there, if you looked at the calendar this week as such, you probably think fairly quiet Monday, Tuesday, but Wednesday, Thursday, Friday, you think that's when I'm going to work. And also you think tomorrow you're going to work. It really doesn't get busy till about 6 o'clock in the evening. And on the Thursday, it's probably midday, and Friday, it's probably early in the morning. So in theory, although there's probably 40 or 50 hours where you could be at your desk, you could basically pencil that into probably about 5 or 6.
Yeah, I mean, that's a very, very good point altogether. So there's an incredible flexibility, whether you're a part-time dad or whether you're a full-time mum or however you're going about this, there are opportunities in trading. The most important thing remains risk management, doesn't it, Neil?
I think, yeah, I mean, you're very much aware of that on the risk management side. And I think I said earlier on, if you look after your pennies, the pounds look after themselves. And I think we were very lucky. One of the platforms we managed to get in is the risk management thing we have with traders. And as we said before, one of the greatest things about David Morgan, who looked after many traders on the live floor, was his risk management. So even though you may have had a £5 account, a 50 grand account, a 100 grand account, and all the prop houses I've worked at before, your risk manager was your favorite man, because every now and again, even looking at Cheltenham, you might as well go there and say, I've got £50 in my pocket, I'm going to bet on those races. You might be tempted to then go to the cash point and get another £50 out. Your risk manager will turn around and say, okay, sir, you've got a £1,000 account. The most you're going to risk today in your £1,000 account is going to be 40 quid. Once you've lost that £40, whether it's 8 o'clock in the morning or 8 o'clock at night, your risk manager say, stop trading. It's not your type of day today. Come back tomorrow. And I think the most important I've learned over the years is the risk management. And it doesn't matter. Some people I've worked with have the biggest accounts, 7-figure accounts, and they still love their risk manager. Not so much when he's hooking them when they've lost money, but also look at on the other foot. If you had a very good day and you've got a £1,000 account and some news has come out, yeah, and you make £200-300, so you've made 30% on your account. You want your risk manager to pat you on the back and as it's St. Patrick's Day tomorrow, to go down the pub and have 10 pints of Guinness because you've had your best day so far.
Absolutely. He's got to be there and say, like all those great Irish sages would say, you've done well, grasshopper. And I think also there's a great point there, actually going back to the very early remarks that I was making this evening. I mean, Ivana Gazic of the Zagreb Stock Exchange, talking about International Women's Day, she was pointing out the fact that women frequently are much more risk conscious. And therefore, I think, Susan McFarlane, in answer to your question again, it is something that can be incredibly attractive to stay-at-home moms. And unlike the floor, you don't have to jostle in order to manage to get your orders in. You're putting it down the computer, and the computer doesn't know whether you're male or female or large or small or inexperienced or experienced. And that gives you the same kind of terms as everybody else is playing on.
Well, I think, you know, obviously from leaving the floor, and people can remember, we all had to have our own mnemonic when trading. It was a 3-letter mnemonic, and therefore we went onto the anonymity side. So obviously no one knew who was trading. But the downside to that, you know, off a tangent as such, part of the problem with the market manipulation and the market abuse is that we don't know who's cheating now. So therefore, whereas beforehand we could nip it in the bud, if someone who's a badge like NWB, NatWest Bank, or Goldman Sachs, GSF, you were going, sorry, you two, you can't do that because we can see it. Now, because we've got tens of thousands of traders who are under anonymity and just a 7-letter code, yeah, get away with it for, say, a week or 2 weeks, and maybe they may be fined 4 or 5 months later. But the problem being is that the market has been abused, and the people who have lost money are the ones who suffer.
Yes, absolutely. And thank you very much, John Falk. Thank you for that message. Sorry you have to go in the last 5 minutes of the programme, but we appreciate your kind remarks, and your very kind remarks about Neil as well. He's been a super guest this evening. He's got another question lined up immediately, Neil, even though we've only got a few minutes to go. Martin Watkins, a previous guest on this, member of the Chartered Institute of Bankers, amongst many other things, member of the court, no less, I do believe I recall correctly. Martin, good evening. Is the emergence of digital assets going to have a profound effect on trading strategies and the approach you are taking, or you will take, when teaching people to trade?
I think that is such a fantastic question and a really harsh question to ask. However, I will attempt to answer it. And I think I'll go back to when the euro first came out, and we had a Mr. Duesenberg, who I think was the first chairman.
Yep.
Yep. Yeah, and probably not the best chairman. And I think obviously when the euro first came out, we all turned around, and obviously you remember it from before, when we were trading Germany, we traded Deutschmarks, French francs, lira, you know, you name it, every currency. Yeah, and we were thinking at the time then, how will the euro work? That's going to be a load of crap. No one's going to trade it. And the same thing, wind on 5-6 years time. And I think at the time, Duesenberg came out and said, I think the euro's a success now, because I went down to my local town and bought a McDonald's hamburger, and it cost me 2.4 euros. So therefore, time is a great believer. The same with cryptocurrencies, everything else. How do we teach cryptocurrencies? How do you become a professional trader in cryptocurrencies when they've only been around for 2, 3, 4 years? And currently, to me, you can't go and buy say a McDonald's with a Bitcoin. Soon you will. And the same thing on our courses. We're currently, today I was chatting to my boss and saying that we're going to have to rewrite some of our courses, and obviously include not just the cryptocurrencies, the digital assets in there, but also the mechanics behind it. And I like the blockchain. I mean, one of the questions we ask most people are like, how many cryptocurrencies are there in the world? And do you know, Patrick?
Oh, it's umpteen thousand. I mean, it was
5,000 years ago, of which probably 3,500, 4,000 are completely crap.
Yeah, oh, easily. I mean, it's Pareto's law. I mean, 80+% of them have always been completely rubbish. And but on the other hand, one of them listed on Binance yesterday, I do believe, and promptly went up. I think it was 6,000%. I mean, that's quite a first day pop by any stretch. And I'm certainly not advocating cryptocurrency investment, ladies and gentlemen.
That goes back to one of my questions I'm going to say to you, is that something that moves 6,000% in an hour or 2 hours is, as I said before, one of the criteria for an exchange to put that onto exchange, yes, and become an RIE, was it a recognised investment exchange, is the simple thing. The main job is to provide a fair and orderly market. And sadly, something that goes up 6,000%, it was either priced wrongly on the opening, which then years ago you would have kept it in pre-opening. I think if we go back to Alibaba when it IPO'd a couple of years ago, yeah, it was pre-open at like 3 o'clock. I think it pre-opened like 4 hours later, and the pre-open price kept going up and up and up, which is better than it suddenly jumping 6,000%.
Yeah, I mean, it's quite absurd. It makes you wonder what the exchange is actually managing to do, because it certainly doesn't strike us that exchange is running an orderly market, which I think was actually part of the job that exchanges were supposed to have as a primary task.
I think, years ago, I mean, and I've had many quips and grumbles with them, the market supervision department has a very simple job, because they've got a depth of market. They can see who's trading. They can see the bid and offer 20, 30, 40, 400 prices up and down the market. So they know when it opens, what could happen if someone wants to flip the market, do everything else. It is so easy to see market abuse. However, I've always said, who regulates the exchanges? The exchanges are there to make money. And obviously, if it jumps 6,000%, that's going to create volume and profits for the exchange. Is it fair and orderly? Sadly, fair and orderly doesn't pay their bills.
Quis custodis ipsos custodiet, as of course we all used to say on the live floor back in the Royal Exchange days. Who guards the guards? So, Neil, one final question. We've actually run out of time today, but I'm going to give you a last minute. Tell us something exciting about what you're looking towards in the world of trading in the near future. Right,
I thought about this because I knew you were going to ask him this question. With Mr. Biden, with the stimulus bill, with the 65 billion that Mr. Sunak found for lockdown and it has to carry on, what I'm saying, I'm not advocating it, but and obviously we mentioned Robin Hood and the share for Nottingham as such. I'm going for the Tobin tax, the financial transaction tax, which I think we have to be prepared that it will come into the market. We know many times before when it's been tried in Italy and Sweden, it does not work. However, when Joe Biden's going to find someone to pay for this 1.8 trillion, and he's going to put his corporation tax up and income tax up to 80%. My version is very simple. My offer to the gods is, obviously, as an independent trader, rather than have a financial transaction tax, why don't we have a financial alternative cancellation tax? Anyone who puts their orders in and are filled doesn't pay the tax. All those people who cancel their orders, i.e. flash liquidity, will have to pay a fee. Thank you.
What a fascinating concept. Well, I'm sure that debate's going to run and run with the audience, and indeed in the pages and the pixels of Exchange Invest. Neil, the idea of an alternative financial transaction tax, a cancellation tax, is that the way for Joe Biden to make himself a solvent $1.9 trillion man? Of course, that's the amount of money that he's already spent. Neil Crammond, thank you very, very much. You mentioned the fact that it takes, as Warren Buffett said, up to 500 pages of research reading per day in order to be a great investor. Ladies and gentlemen, here's a hint. If you want to manage to know all about what's going on in exchanges, Exchange Invest processes more than 15,000 pages of information every day. Let's look ahead. I mentioned earlier that this week, Neil was a fascinating sandwich between Gresham College professors. Next week, we're going to be joined by someone who's got one of the oldest offices in the world of financial centres. We're going to be meeting Professor Michael Manelli, an old friend, and he is this year the Sheriff of the City of London. He's the aldermanic Sheriff of the City of London, for indeed there are two. We're really looking forward to having him as a guest, talking about the sustainable city and beyond. For this evening, it's been an absolute joy to have you here, Neil Crammond, talking about alternative transaction taxes, talking about ways that we can manage to reduce the 80% failure rate of retail traders and bring them down towards a more manageable level, and therefore prolong not just the amount of liquidity they can bring to markets, but also add to their overall home domestic liquidity of their portfolios. That's going to be, I think, something that it takes that's really important, because it does indeed, as you say, likely take you 12 to 15 months to be competent, but nonetheless you're offering these fascinating opportunities to have a month of very, very in-depth training throughout. Thank you very much, Martin Watkins, offering us the fact that it's been superb comments and an IPO video. However, he fears that a synthetic financial transaction tax will hit our pensions, and he'll be intrigued to see how that pans out. Who knows, one of these days we might just have an IPO vid devoted to the whole concept of how alternatives like to the financial transaction tax might actually play out. Susan McFarland, screw your courage to the sticking place, if I may encourage you to do so. Go forward, start reading. You can be a great full-time mum and a sensational trader in between during the course of those hours. Thank you very much to Agatha Bellon, to John Falk, to all those of you who've managed to make comments this evening, George Brown for your questions. It's been absolutely a joy having Neil here in the studio. I wish you a very profitable FOMC meeting during the course of this week, tomorrow evening. So therefore, I hope, ladies and gentlemen, you won't be going excessively in terms of St. Patrick's Day tomorrow, but I wish you a very happy St. Patrick's Day there, and culturally appropriate as much as you can. This has been the IPO video, issue number 25. From myself, Patrick L. Young, I'll see you in the pixels of Exchange Invest over the course of the next week. To all our subscribers, thank you and good night.